Hello and welcome to QHD 101, the basics of qualified high deductible plans and health savings accounts. My name is Rob Gluss and I'm a consulting actuary with Conrad Siegel, and I'm here with Kristen Parker. We're going to go through a presentation today giving everyone a background on a new health plan that Gettysburg College will be offering in 2019. We want to educate employees about this new design, understand how it compares to their current PPO plan design, and make sure employees are aware of the value that the qualified high deductible plans and specifically the health savings accounts can bring to their plan. A couple of housekeeping items. The first thing is we do use some samples in the presentation. Want to make it clear that those samples are just that, they are samples. It's not indicative of the exact plan design that Gettysburg will roll out in 2019, but it should be fairly closely representative of the kind of design that we expect to have for the 2019 year. We will have some more information sessions in the fall leading up to open enrollment. After we have more specifics about the exact plan design, we'll be able to give employees more information so that they can make their decisions as they're leading up to open enrollment. So to get the presentation started, I'm going to hand it over to Kristen Parker and we'll get started.
So the first thing we want to talk about today is just the agenda is really pretty short. We're just looking to talk about the two main pieces of information that you'll need for open enrollment in the fall. One is what a qualified high deductible health plan is, and the second being what a health savings account is. We will have some sample questions that we've received at other earlier sessions on site that we'll review during this presentation as well, so you can get an idea of the questions that others have been asking. So the timeline for what we're looking at here is, as Rob's already mentioned, we're looking at adding a new plan design at January 1st of 2019. The intent is not to necessarily replace plan designs that you have today, but to add something new that will be offered. And also, as Rob had said earlier, we will have some additional sessions for education purposes throughout the summer and into the fall months, so that you can have other opportunities to learn more about this plan design and what it entails. So there are two separate components that are important to understand when we're talking about qualified high deductible plans and HSAs. These are two separate vehicles. Often someone will say a high deductible plan or an HSA. They are separate, they're not the same, but they do often work together. And this is similar in concept to the PPO plan and FSA, or flexible spending account arrangement, that you have today, but they aren't the same. There are some unique differences. So the qualified high deductible plan is very similar to the standard PPO plan that you have now. The network of doctors and hospitals that you have today will be the same regardless of which plan you choose. The coverages, the types of services that are covered, will be the same under both plans. So the plans in and of themselves are very similar, but there are a couple of key differences in how they're functioning, basically because the IRS, or the federal government, requires qualified high deductible plans to have certain rules attached to them. The two main differences are listed on this page. The deductible that you have today, we typically think of a deductible under a PPO plan being attributable to services that don't have a copay. So that's what you're used to having. Under the qualified high deductible plan, that will change. The qualified high deductible plan deductible applies to all services first. So that includes whether you have an office visit, an inpatient stay, a prescription drug, whatever the service or the health plan costs you have will be applicable to that deductible first. That's right up front. The exception to that rule is preventive care. So physicals, well child visits, things of those natures will still continue to remain zero cost for the member. But everything else will be attributed to that deductible first. Once the deductible is paid in full, then the plan will continue as what you're used to today. The second difference has to do with how the deductible is structured. So today, for example, you have a $1,000 single deductible and a $2,000 family deductible. Sorry, let me say that differently. A $2,000 family maximum. So each individual person has a $1,000 deductible up to no more than $2,000 for the family unit. That is different under a qualified high deductible plan. Under the qualified high deductible plan, the deductible truly is a single deductible and then a family deductible. So anyone that has more than one person covered by the plan must meet the full family deductible before the plan is paid anything at all. So for example, the same concept of the 1,000, 2,000, it would be 1,000 for a single employee, but the full 2,000 would be paid regardless of whether you're a husband and wife contract or a family contract. So those are the two main differences between the PPO plans and the qualified high deductible plans. Another one of the rules that the qualified high deductible plans have is that the deductible has a minimum that is required by the IRS. For 2018, this deductible, minimum deductible is $1,350 for a single and $2,700 for a family. And these deductibles are indexed annually. They may change by $50 or $100 each year as determined by the IRS and the federal government. One item to note, as we've considered whether or not to include this as a plan option, because Gettysburg College already has plans with deductibles in place today, those deductibles will likely continue to increase and would be getting fairly close to the qualified high deductible plan limits. So adding this as an option makes a lot of sense, as we will talk about the health savings account and the value of that health savings account a little bit later. So just to kind of give you an example of what a sample plan design might look like, on the left-hand side of this screen, on this page, you see what your current PPO 1000 benefits look like. So if you're in the PPO 500, these may not be exactly what you're used to, but this is the PPO 1000 that Gettysburg College has today. Very high-level summary. On the right-hand side of this is a sample plan, and you'll see that pretty much the entire plan is the same, with the exception of the deductible. Under the sample plan, it's $2,000 for a single and $4,000 for a non-single contract. So a family, a husband and wife, would pay the full $4,000 deductible before the plan's benefits would kick in. And you'll also note that under the prescription drug benefits, the deductible is applicable there as well. So the deductible for the whole family, it covers everything, not just the medical claims. We wanted to kind of give you an idea of how these differences would play out in a sample person's claims during the year. So we have 2 pages that kind of summarize what a sample person's experience might be. For example, this person is an employee only, so this is a single contract, and using the same sample plan on the previous page compared to the current PPO 1000. So for example, this individual on February 15th received a prescription drug. The total amount of that drug, which noteworthy is that that's the discounted amount that Highmark gives. So you would always be paying whatever the discounted price that the carrier has previously negotiated. The discount on that drug was $70. Today, based on the plan design you have, the copay for that prescription drug will be $10. If I continue down the list, you'll see a month later they received a second prescription drug. That one's full cost of $110, but the copay is still $10. On March 29th, the member had a preventive visit that cost $85, but since it was a preventive visit, there is no cost to the member at all. Going down the list, April 1st, the member had an x-ray worth $220, and that $220 would be credited to the member's deductible, so they would pay the full cost of that x-ray. On May 16th, the member had surgery that cost $4,600. The member would pay their remaining deductible towards that surgery of $780, and then they would pay coinsurance on the rest of that. Up to $382 would be the amount of coinsurance the member would pay. The remaining benefits there, the prescription drugs and office visit services, would all be applicable to the co-pays for that service. $10 for the generic prescription drug, $40 for a specialist visit, $70 for a brand non-preferred prescription drug, and so on. So the member's total cost down there is $1,000 toward the deductible, $382 towards coinsurance, and $200 in copays. So the total cost for the member out of their pocket was $1,582 for the total cost of all their services combined of $6,085. So that's how it would work today. If I compare that with the sample qualified high deductible plan, the first $2,000 worth of services would all go towards the deductible. So you can see those prescription drugs, the first two things on the year from February, March would be the full cost of those prescriptions, $70 and $110. The March 29th preventive visit would still remain $0 for the member because it was preventive. The x-ray and the surgery would be going towards the deductible, and once we get to the surgery, the deductible is hit. After that, coinsurance again would come into play, and the member would pay $300 in coinsurance. Because the deductible's met, now the plan's going to continue to function exactly like it had previously functioned. So the copays in our sample plan are exactly like the copays under the PPO 1000 today, and we have the same out-of-pocket costs for those members. So you can see at the bottom, the member would have paid $2,000 in deductible, $300 in coinsurance, and $180 in copays. So the same $6,085 total cost, the member would have picked up $2,480 of costs. Clearly, the member is paying more out of pocket, so your question, of course, would be, why are we doing this? And there's a couple reasons why, and we're going to get to one of them very shortly, but one of the reasons is because the value of the HSA account from a tax vehicle is very powerful, and it's a good opportunity for those that have opportunity to save for the future and also pay for current expenses at a tax preferred standard. The second is because the premiums are lower and the cost to the employee out of their paycheck is going to be lower with this type of an arrangement. So those two things factored in will show that eventually these plans will be very beneficial to many employees and a good option for a lot of people. I do want to show you quickly a similar type of situation for an employee with a spouse. So this is a very similar analysis that I have just walked through with the employee only. This is an employee with a spouse. And the main differences to note here is that the deductible under the employee and spouse on the current PPO plan is capped at $1,000 per person and a combined total of $2,000. So you can see each individual, the employee in April and May with their x-ray and surgery, and then the spouse with the x-ray and surgery, and the employee later in December with the surgery for $1,000. So they each get credited separately. Under the qualified high deductible plan that has a $2,000 single deductible and a $4,000 non-single, or in this case husband and wife deductible, the couple has to first meet the full $4,000 in deductible before the plan starts to pay. So similarly, you'll see that the cost will accrue in this situation where after you meet the deductible, then the plan design will kick in and the copays and the coinsurance will be what the members pay. In this case, the total cost for the year for the couple is $16,085. Under the current PPO plan, the out-of-pocket cost would be $3,482. Under the qualified high deductible plan, the cost is $5,280. So the plan is still paying a good share of the total expenses. These are good plans with good benefits, but they are structured slightly differently. Now I'm going to turn it over to Rob, and he's going to explain the health savings account portion of these plan designs, and you can see the value that they bring to the table.
And this is normally where we tell everyone, if you stop the presentation right here, everyone would say, why in the world are we going to these qualified high deductible plans? And the answer is, because I need to have a qualified high deductible plan in order to get access to a health savings account. And the next thing we're going to go over are the specifics and the intricacies of the health savings account and why this can be a really powerful thing for the employees as a saving component for their healthcare expenses. So the first question is obviously, what is an HSA? Well, very simply, an HSA is simply a savings account or a checking account. It's an account just like anybody else has, except it has three very distinct and really powerful qualities. It has a triple tax advantage. It's tax deductible when contributions are made to the account. It's tax-free as interest and information or dollars build up in the account. And then it's tax preferred and tax-free after you withdraw the money, as long as you're using it for qualified medical expenses. That is a really powerful account structure that really doesn't exist anywhere else. So getting access to that type of account and having to have a qualified high deductible plan in order to get access to a health savings account is sort of a necessary evil. The health savings account allows you to pay for qualified medical expenses that you may not have covered under your regular health plan. Now, many of you probably have a flexible spending account. Really, an HSA works very similarly to a flexible spending account with a few subtle but very important differences. Number one, the HSA money is yours to keep. Any unused money in your account is not forfeited at the end of the year. You do not have a use it or lose it component to the plan like you do in the flexible spending account. An HSA is your money. Once the money goes into your account, that account is your property, and that money can never be forfeited, regardless of whether you continue to be enrolled in the plan, or it's also portable. It doesn't matter if you leave an employer and go to a different plan or go to a different employer, that money always remains with you, and you are allowed to use that money for any qualified medical expenses for you or your tax dependents. Bottom line, the HSA puts you in control of the money that's in your account. We'll talk about some more of the nuances later, but you don't have many of the restrictions that a flexible spending account has, including having to file claim forms and substantiate all of your claims before you get reimbursement. Again, it's your account. You decide when the money gets withdrawn, and ultimately it's your responsibility to certify that those are being used for qualified medical expenses. So who can have an HSA? And this is important because as soon as we get into a significantly tax-preferred world, the government usually steps in and puts a lot of important requirements on people. So you have to satisfy these four criteria in order to contribute money to a health savings account. One, we've sort of already talked about, you have to be covered by a qualified high-deductible health plan that satisfies all the nuanced rules that Kristen had mentioned earlier in the presentation. Second, I can't be covered as the employee under any other health insurance coverage. Now, that's an important concept because I can't be covered as a secondary payer, even on a spouse's employer. I can't be covered under a spouse's flexible spending account as a dependent. All of those would sort of disqualify me from being able to make contributions to an HSA. Important to note, it's about whether you're eligible for other health insurance coverage. It does not matter whether your spouse and your dependents are eligible for other health insurance coverage, only that you, the contract holder, the employee of Gettysburg, is not covered under any other first dollar health insurance coverage, unless that other health insurance is another qualified high deductible health plan. The third component is that you are not enrolled in Medicare. And enrollment in Medicare, generally, we're talking about people who are eligible for Social Security and eligible for Medicare over age 65. Now, a lot of people, once they reach age 65, when you file for Social Security, you immediately become enrolled in Medicare Part A. That, in and of itself, would disqualify you from being able to contribute money to a health savings account. So there are options for people once you reach Medicare eligibility age. If you were still an active employee and an active member in the Gettysburg plan, you could agree to not forfeit, but delay your implementation of your Medicare and your Social Security benefits. But again, as soon as you begin to enroll in Social Security and sign up for Medicare Part A, you become ineligible for HSA contributions. And the other component is you cannot be another person's dependent. Sometimes this could possibly happen if you have young employees who maybe still, for some reason, filed as a tax dependent on your parents' tax return. Doesn't happen often, but it could. You cannot be another person's tax dependent on their tax return. So HSA contributions, again, we're in a tax-preferred world, and the IRS will limit the amount of money that someone can put aside each year on a tax-preferred basis. For people that are covered under single coverage, that limit for 2018 is $3,450. And if you have family coverage, the limit is $6,850. There's a catch-up contribution for people who are over age 55 that you can put an extra $1,000 in for the plan year up to that limit. Now, for example, as a comparison, the flexible spending account that you might be eligible for today, I believe for 2018 you can put up to $2,650. That's regardless of whether you're covered as a single or as a family. So again, there is some additional opportunity to put money aside into a tax-preferred account that has, again, some of the benefits of a flexible spending account, but doesn't have the use it or lose it requirements that you may be subject to today. So these contributions can also be funded by either the employer or the employee, and we're going to talk a little bit later as we give a sample. Likely the college will fund some money into this health savings account to cover some of the extra out-of-pocket costs associated with the high deductible plan. Again, we're just giving samples right now, but for example, if Gettysburg decided to fund $500 for single coverage and $1,000 for family coverage, an employee could add up, if they were covered under single coverage, they could add another $2,950 into their health savings account, or if they're covered under family coverage, they could add up to $5,850 to their account. Now, contributions can be done in a couple of different ways. The most simple way for the employees, and the way that's generally done, is through their Section 125 plan. Employees can elect to make pre-tax payroll deductions into their health savings account on a tax-preferred basis. Now, the one interesting thing about HSA contributions is that they can be started and stopped really at any time. Whereas today, when you make a Section 125 plan election for your flexible spending account, you cannot make any changes to that unless you have a change in family status. The health savings account, you can stop and start your deductions whenever you see fit, subject to the limitations that the plan may put from an administrative basis. Again, they may only allow that every 2 weeks or once a month or something similar to that. But again, you could make changes to that HSA contribution more frequently. Some people who necessarily don't max out their contributions through the employer contribution and through their own pre-tax payroll deduction can actually make post-tax deposits directly into your HSA at any time during the year. They don't get the payroll deduction tax benefit of it, but they will be able to then take the tax benefit when they file their taxes at the end of the year. This is a very important, powerful thing with the health savings accounts in that, again, it is your account. It's an account that you have control over, and to the extent that you haven't maximized the tax benefit for any particular year, again, you can run all of your out-of-pocket expenses from your health insurance, from your dental, vision, any eligible medical expense you could run through the health savings accounts in order to take the full tax advantage of paying for those expenses. The last bullet here on contributions is you will have investment options in the HSA. Again, just like any other account, once you build that account into a substantial fund balance, you will have an opportunity to actually choose some investment options to potentially achieve some higher returns than you otherwise would in just a simple checking account or money market account. Again, distributions from the HSA, as we said, HSA money that's used for qualified medical expenses can be withdrawn from the account tax-free. This includes things like the medical plan deductible, your office visit copays, prescription drug copays, co-insurance. Also includes dental, vision expenses. Basically anything that can get reimbursed by your FSA as an eligible expense is also eligible as a qualified medical expense through your HSA. Again, but you do not have the same use it or lose it requirement if you don't use the money in your HSA. You get to keep it and roll it over for use in a future period. A couple of other things about taking distributions. One difference between the FSA is you have to have the money in your account in order to spend it. Again, it works just like any other regular checking account. I can't overdraw the account. I have to have the money in the account to use it. Flexible spending accounts, you may be aware that when I make an election for the year, I could actually get reimbursed 100% of those monies up front at the beginning of the year if I have qualified expenses, and then I will simply have it paid for through payroll deduction for the rest of the year. In the HSA, again, the money has to be in the account to use it for qualified medical expenses. If you have non-medical withdrawals from your HSA, they are potentially subject to a 20% tax penalty. So if you withdraw your money from an HSA prior to age 65 for non-medical expenses, you would pay a 20% excise tax penalty. Now, once you become age 65, after age 65, you can still withdraw the money for non-medical related expenses. You would not pay the 20% tax penalty. However, you would just pay ordinary income tax, similar to taking money out of a regular retirement account at that point. There are exceptions also for when you are become totally and permanently disabled. You would not have to pay that same tax penalty, or unfortunately, if you would die, that 20% tax penalty you would not be subject to it. The last thing about HSA distributions is you can only use money in your health savings account for true tax dependents. It does not matter whether they're covered by the health insurance, but in order to use money in your health savings account, your dependent has to be a true tax dependent on your return. Now, again, this comes into play for a lot of instances where plans are required to cover adult children up to age 26 in a lot of the plans these days due to healthcare reform requirements. However, if you can still have that adult child covered under your plan, but if they are not a tax dependent under the plan, you would not be able to use the money in the health savings account in order to pay for any of their specific incurred expenses. So again, that's an important thing just to note with the health savings accounts. Now, after talking about all of those things, we wanted to try to kind of put it all together. We started this presentation by talking about what's a qualified high deductible health plan and what is a health savings account. Well, again, I have to have a qualified high deductible plan in order to get the benefit of the health savings account. I'm going to have higher out-of-pocket expenses, but here we're going to show you that those higher out-of-pocket expenses are generally going to come with reductions in premium cost, reductions in the employee out-of-pocket costs that they pay for premium sharing or through payroll withholding, plus amounts funded by the employer could add up to fairly significant savings for the employees. This example is the same example that Kristen went through previously, where I compare the current PPO 1000 plan to a sample qualified high deductible plan with a $2,000 deductible. As she showed before, under the regular PPO plan, I have $1,582 in out-of-pocket expenses for deductibles, coinsurances, and copay. And the qualified plan, I have $2,480. So if I just stop by looking at the elements of the plan, I would have roughly $900 in additional expense by choosing the qualified plan. Well, why would I do that? Well, I would do that because on one hand, I also am going to have to pay less for that particular coverage. Just as an example, I'm going to pay $756 for the PPO 1000, but again, just as an example, I might only have to pay $143 on an annual basis to get into the qualified high deductible plan. So again, I'm saving roughly $600 in that circumstance just on the payroll withholding and the cost of the coverage. Then, not only am I saving money through the payroll deduction, but the employer may also fund part of my health savings account and part of my deductible exposure. If we assume that the employer provides $750 of contributions to the HSA, now what looked like an out-of-pocket increase by being in the qualified high deductible plan has now shown up to actually save the employee $465 for the year. And these are examples where the deductible has been fully satisfied. So people are maxing out their deductible in this example, and I still save money by being in the qualified high deductible plan. This, again, goes to one of the questions a lot of people think of. They get very scared when they think about going into a qualified high deductible plan because they think they're going to have a lot of additional out-of-pocket exposure if they have significant medical expenses. This actually provides a good example where someone who maxes out their deductible so they do have significant medical expenses still actually makes out better. Obviously, if somebody didn't have any healthcare expenses for the year, this would work out extremely well for that person because not only would I have no member out-of-pocket costs, but I would save the money for payroll withholding, and I would be given a contribution to the HSA, which I get to keep and I get to roll over for use in a future health plan period. So again, a very powerful thing when you look at the net cost of coverage with the health savings account and the qualified high deductible plan. Similarly, we looked at that same example where we had a two-party coverage, an employee and a spouse. Again, very similar results here. Roughly $1,800 in extra member out-of-pocket cost if I simply look at the plan design components. However, I can save possibly $1,500 in employee payroll withholding because of the less premium costs associated with that plan and the employer making a contribution to the health savings account. This employee who maxed out their deductibles, so again, generally a family unit with fairly significant medical expenses, they still saved money in the qualified high deductible plan as opposed to the regular PPO because of those other components of the plan. So as we move forward to the fall and we add this plan design as a component, depending on what the plan design specifics actually look like, it's going to be really important for employees to actually do the math. Take a look at the qualified plan and understand there can be significant value created by moving into a qualified high deductible plan and having the health savings account that not only can, again, create this savings, but I also have the added flexibility of being able to pay for some of my member out-of-pocket costs by running those costs through my health savings account and getting an additional tax benefit that I otherwise would never be able to get if I only had a flexible spending account that, again, ideally I couldn't use as effectively as I could use the HSA. So with that, we've come to the end of the presentation. As Kristen mentioned at the beginning, we do have some questions that employees have asked at some of our other sessions that we wanted to walk through. These are fairly common questions that you might be thinking about as you have finished listening to this presentation, and we'd like to go over just a few of those with you right now.
So one of the common questions we receive is regarding retirement. As people look forward to retirement, because who doesn't look forward to retirement, what happens to the health savings account and the money that they've saved? And the answer really is any money that's in your health savings account, you will always be able to keep and spend on a tax-preferred basis for medical expenses. So even Medicare, you're eligible for Medicare, you no longer can put additional contributions into your health savings account, but you can use the money that you've saved for any out-of-pocket expenses you might have. And there are some additional things that you can spend money on at that point in time as well. The additional premiums you might have and things of that nature. And we can get into details about that another time. But the money is always yours, and as long as you use it for medical expenses, then it will be on a tax-preferred basis.
Another question that employees had was, if a contract holder or employee dies, what happens to the HSA funds? And the answer is, just like any other account, there are beneficiary designations that people will have with the health savings account. If the beneficiary is the spouse of the employer or the contract holder, that money simply transfers as an HSA to that spouse, and they get the same tax advantages that they would have had they, had the employee stayed living. It just transfers over to the spouse. If the beneficiary of the account happens to be a non-spouse dependent, then that money would be distributed to the beneficiaries. It would be taxable just like any other account distribution. It simply would not be subject to the penalties associated with having withdrawals for non-medical related expenses.
A question that we often get regarding qualified high deductible plans and HSAs is, are these accounts and these plans really just for people that are healthy, and the people that are sick, don't get the value out of these plans? And the answer to that really is no. These plans are good plans for really anybody. The coverages are good. There are additional out-of-pocket exposures on a qualified high deductible plan than many PPO plans. That's not always the case, but it certainly would be the case for Gettysburg College employees. But the value of the health savings account really offsets that, and the additional costs, once we factor in both the out-of-paycheck cost and the tax savings, as well as any contribution that the employer may give, they become very valuable. And we often find, when we run scenarios using actual people's experience, that folks that have a higher cost of coverage in terms of out-of-pocket costs actually work out better than even people with the lowest. So they are very good plans for almost everyone, and I think that's something that most people should consider, these plans.
The last question that we were getting, and I believe we touched on this earlier in the presentation, was if you're turning age 65, can you still contribute to the health savings account? And the answer is, I can only continue contributing to the health savings account if I'm not enrolled in Medicare. Again, most people, when they file for Social Security when they reach age 65, they become eligible immediately for Medicare Part A, and they become ineligible for HSA contributions. Employees, however, can defer enrolling in Social Security and still remain eligible to make contributions to their HSA, but they would have to defer signing up for and receiving their Social Security benefits. Whether or not that is the right decision for you to make is obviously a very personal decision, and should be something that, if someone is considering making that decision, they should consider the pros and cons of deferring their Social Security benefits as opposed to being eligible for the HSA and any HSA contributions. So with that, that comes to the end of our presentation. We thank you for your time and attention, and we would ask that you keep an eye out for future presentations regarding health savings accounts and qualified high deductible plans as we kind of lead up to open enrollment for the 2019 plan year. Thank you.